Alright guys, so in today's video I'm going to be walking you through how to use this real estate investing spreadsheet.
Open eye, feel the waves cut through me, hypnotized by the sounds I'm breathing in. Hold tight, hold tight.
Alright, so in this video, as I said, we're going to be walking you through how to use this real estate investing spreadsheet. So if you've got some properties that you're looking at and you want to be able to compare apples to apples, you know which one's a better deal, you can individually go through the spreadsheet and plug in all the details for one property and it'll spit out a return on investment, and you can then type in all the information for the next property and it'll compare the two, so you'll be able to see which one's going to produce a better return on investment. So we've got the black numbers. These are your do not alter numbers. We've got blue, which are the ones that you can change for different descriptions about the property. And then you've got your actual numbers that you're trying to analyze. These are going to be your red numbers, and you can change those. So the black is your formulas. Once you plug in the red numbers, it'll spit out calculations. So starting out in section 1 here is the property information. So the property address, we've got Prospect Street here in Elkhart, Indiana. And we've got 3 bedrooms, 2 baths in this property. So this is an actual deal that we just recently sold for a $75,000 profit. We bought it a couple years ago when I was 20 years old for 30 grand. I partnered up with my father to buy it after talking him into getting back into buying properties. He's had rental properties for several years. I wanted to get into the game, so I partnered with him. We bought the property and now we sold it 2 years later for a $75,000 profit. So I'm kind of going to walk you through some of the similar numbers that I used when I was first analyzing that deal. Of course, things have changed now that we've actually gone through and spent all the money on renovations and actually sold the property, but beforehand it's kind of easy to predict a lot of the stuff. So heat source, natural gas was what ours was based off of. We bought the property for roughly $30,000, and then I estimated we'd have about 15 grand in repairs, and the estimated after repair value is 120,000 because this is the actual value we sold for. I think originally when I was running the spreadsheet I was putting in 75, 80,000, being way too conservative, but now that I know that it actually sold for 120,000, I can put that value in just for kicks and giggles to see what kind of return shows up over here in the profit and expense sharing category. So then down here we've got some more descriptions. So ours had an attached garage, it had a laundry room, it was built in year 1908. Wiring condition, plumbing condition, we put unknown. When you first are going through a property, you probably don't know this information. Square footage, ours was about 1,800 square feet, and according to the tax records, it was appraised at about $28,800. So then we've got section 2. This is where we can analyze the cash flow if you're trying to hold it as a rental property. So starting out, we've got purchase price. It automatically pulls $30,000. Closing costs is going to depend on how expensive the property is, but typically it's not going to vary too much. But you're going to have, title search, you might have appraisal, inspection fees. You're going to have to pay property taxes at some point when you own the property, so that's going to get prorated. The seller is going to give you a credit, so that's going to help knock off, some of the expenses and money you have to bring to closing. But all in all, we'll give it a rough estimate. You're going to probably spend about $1,000 on different closing costs that you pay the title company. Now, if you're using a lender, getting a mortgage, you might have more costs. Because you're going to have to pay, points and different mortgage fees to get a mortgage drawn up. Repairs, we estimated, like I said, about 15,000, so that pulls it from section 1. Holding costs, so this is what's going to be expensed while the property sits vacant, so while it's getting renovated. So let's say over 4 months of renovations, we're going to spend about $500 a month on all the utilities, electric, gas, water, sewer, trash, different property taxes, insurance. So all that's holding costs that you're going to eat while you're renovating the property. So then it's going to want to know how much are you going to contribute towards, the purchase price or the down payment and all your repairs. So in our case, we paid everything cash. So it's going to add everything up here and show you your total investment is $48,000. Since we contributed $48,000 cash towards everything, our total loan amount was $0. That may be different if you're only putting down, let's say, 10 grand and, taking out a loan for the rest. But usually when you go after these low price properties that are in rough shape, the bank usually won't give you a loan. Sometimes they do, but a lot of times they want you to, buy like a foreclosed property that's in rough shape, fix it up first, and then once you get it rented out, they'll send somebody out to appraise it and you could refinance and get a mortgage on it. So we just buy them cash initially, and then later we'll refinance if we want. Number of units, it's only a 1-unit property. It has 1 tenant. It was a nice family that always paid the rent on time. We got fortunate. We had good tenants. They paid $9.25 every month, which is roughly the going rate for a 3-bedroom in our city. And our loan amount down here is where we could have put in, what interest rate and how many months the loan was. And then we've got, the insurance and taxes right here. So it's going to spit out your mortgage payment once you enter in all this information. But our case, it was 0. Monthly insurance, we paid about $1,000 a year for property insurance, and that works out to about $83 a month. Taxes, we paid about $600 a year, so that works out to about $50 a month. Again, these are just rough estimates of everything. I'm not getting into the fine exact numbers because you're not going to know those a lot of times when you're first starting out analyzing a property quickly. Other monthly expenses, this is going to be your maintenance. How much do you expect in maintenance costs to maintain the property every year? So typically I'd say you're probably going to spend $500, $600, maybe more depending on what kind of shape your property's in. Ours was in pretty good shape. Once we go through all the renovations, there hopefully won't be that many repairs to make to the property since we make them all up front. But things still tend to break down, like we had the sewer back up a few times that our tenants called us, so we had to pay a sewage insurance fee to have the company come out and dig up the ground and fix the whole sewer issue. So if you expect maybe $1,000 a year, you could put in maybe another $83 a month here for maintenance costs. So that's going to show you your total monthly expenses for everything is about $216 a month. And again, we don't have a mortgage payments, otherwise our monthly expenses would be higher. And then if you've got other monthly income, so let's say you're renting out, if you have an apartment building, you might be able to collect parking fees, or if you're allowing pets, you might be able to collect pet fees, or laundry income you make from the laundry room. So this would be where other income would go. So in our case, we didn't have any. It was just a flat rent amount they paid every month, so $9.25. Now down here, it's going to calculate everything for you, so let's scroll down and take a look. So our total annual expenses without including mortgage payments is going to be about $2,592. So that's, we're talking roughly, $600 for taxes, $1,000 for insurance, and then about $1,000 for maintenance each year. So that works out to about $2,600 there. And then we're collecting about $11,000 in rent each year. So that's going to give us a cash flow of $8,500 before paying off our mortgage, which we don't have a mortgage. So that $8,500 is direct into our bank account where we can have it as a reserve, or after it accumulates for a few years, you can then go on and buy your next property with that money so that you can, keep reinvesting the proceeds to keep growing your portfolio. So on a per month basis, this breaks down to about $700 per month, which is, a little high. Typically, rule of thumb, you can expect $400 to $500 per month in cash flow. But in our case, we had a good property that stayed rented out the whole year. We had good tenants. They took care of the place. We didn't have that much in maintenance. Our taxes and insurance were pretty low. We didn't have a mortgage, so our cash flow is pretty high in this case. But if you had a mortgage, you could expect it to be, a lot lower, like $300 to $400 per month. So annually, we're making, like I said, $8,500 on this deal. And personal contributions, this is where we said we spent $48,000 towards repairs, purchase costs, closing costs. So we were all in for $48,000. So every year that this property earns $8,500, That's about a 17% return on our money. And then if we were to go get a mortgage, that would cut our personal contribution down. So if we would have took out a mortgage, for 20 some thousand, and we only would have paid 20 some thousand out of our pocket, this is going to, of course, cut our cash flow down, but it's going to boost our return, because whenever you use leverage, your return goes up. So let's do this real quick as an example just to show you. So cash on cash return without a mortgage, we're going to be making 17% a year, which is pretty good. If you think about the stock market, your money is going to sit in the stock market and make about 10% a year. After inflation and all that, it's about 7% over the long term in stocks. So real estate here, we're beating, the stock market returns. But if we want to go ahead and show you what would happen with a mortgage, we'll go ahead and say that maybe we only contributed half, and then we took out a mortgage for the other half. So now our loan amount becomes $24,000 and we paid $24,000. So a 50-50 cash versus loan split. Let's say we got, a 4% interest rate over 30 years. We're going to be paying about $114 a month towards our mortgage. So that's going to impact our cash flow now. So our cash flow after our debt payments, $594. So our annual cash flow now is only $7,100. And our personal contributions is only $24,000 now. So even though our cash flow went down, our personal contribution also went down. So $7,000 divided by the $24,000 we have invested in the property, we're now earning 29% return on that $24,000 that we invested. So that's one of the benefits of using a mortgage to buy investment real estate, is it's going to help boost your returns. But you got to make sure the deal is safe enough that if it sits vacant, you're going to be able to afford your mortgage payments and not go underwater and have to end up foreclosing on the property because you can't make your mortgage payments. But in this case, ideally, if we wouldn't have sold the property, we should have probably refinanced, got it on a mortgage to get that cash out, and then it would have increased our return, and we would have kept the property, so we would have been able to make, a nice annual cash flow. But we just decided to flip it and cash out for our profits and move on. So that's what happened. But it would have been a good rental property to keep, I think. All right, so that was, the returns there. You can compare different properties. All right, Section 4 and Section 3, these go together. So this is going to kind of help you figure out, what the future value of your property could be and what your returns and profits will be. So if you're doing an apartment building, you're going to want to use the cap rate here. You're going to have to find out what cap rate is for your city. And then if you're using, a single family home, you're going to value it based on market comps. So in our case, our market comps were $120,000, since that's what we sold it for. That's kind of the range we were thinking we could get for it. Closing costs, let's say, now that we're selling it, we'll say it's going to be about 1% of the property value. So we'll say $1,200 in closing costs. Real estate fees about 6%, so that's going to multiply 6% times the sale price. So the net proceeds after these costs get factored out is going to be about $111,000 is how much we would profit if we were to sell at $120,000. So taking those numbers, we can come down here to Section 3 now. So our total investment of $48,000, let's say we held it for 2 years. Then our future sale price less closing costs, it takes that $111,000 and plugs it in there. So it's going to show that our sales profit is $63,000. And then we've got, cash flow over our 2 years. If we're making $7,133 a year, then that's what's going to plug it in there. So $14,000 is how much cash flow we'd get holding it as a rental for 2 years. So our total profit over the 2 years is going to be about $77,866. Down payment of $24,000. So our ROI per year is going to be about 162%. Since we had so much equity built into the property, since we bought it so cheap and then we flipped it for such a big profit, that gets combined with your cash flow. So our annual cash flow return was 29%, but our total return is going to be 162% because of all the equity that we got in the property by buying it so cheap. So if we were to say that we're going to hold this property over 15 years, then our average return over those 15 years would still be about 47%. So clearly this was one of those home run deals where, we bought at such a cheap price, and it was worth so much more that our annual return is going to be really high. So it's hard to get these kind of numbers in the stock market. This is why I love real estate investing. You can build wealth quickly. I from age 20 to 22, doing 2 different real estate deals now that we've made, 6 figures on. I've been able to make over 6 figures myself, and then my dad's, of course, made over 6 figures because we're 50-50 partners. So, in 2 years to make that kind of money that quickly in real estate, you can't really do that in stocks. If I only, had 20 grand to invest in stocks, I might have made $2,000 or $3,000 from the stock market over that time. So I've been very fortunate to, get into real estate investing and find such good deals to build my net worth so quickly. And that's kind of, my little rant of why I believe you should invest in real estate over stocks, just the kind of control you have to build wealth quicker than stock market, which could tank any day. So moving on, partnership evaluation, profit and expense sharing. So in this case, it's going to plug in your different numbers here. And then if you're going in on it with a partner, so let's say each of us, maybe we each paid $12,000 towards our down payments, because over here, remember, we put in that we took out a loan even though we didn't, but just for purposes of the spreadsheet, we each will say we put down 12 grand. And so our total investment, total loan amount, number of units, average rent per unit was $925. It puts in these numbers: total loan amount, mortgage payment. So this is pretty much the same exact column you're seeing over here, except this column over here to the right is for partnerships, whereas this one's just, in general. So it's a lot of the same information you got to plug in twice to see what your breakdown would be if you're going in with a partner. So it's going to calculate that your mortgage payment you're responsible for, which obviously is going to be half of this, so $57.29. You're going to be responsible for half the monthly insurance. So what I would do is, I guess I would take and, you could put in a formula here where it says it's taking this cell and dividing it by 2. So you're going to be responsible, for the $41.50. But depending on if you're, what kind of share of revenue you're getting in a partnership deal, that could differ. So I'm not going to go ahead and put those formulas in. You could just manually calculate everything. So we'll plug in $41.50 here. So dividing property taxes up, you're responsible for $25. And then here we're responsible for $41.50. So the $216 a month, I'm responsible obviously for half that, so $108, which means total monthly expense $165. Total monthly income towards rent is $462.50. Total annual expenses about $1,300. So my net operating income is going to be about half that $8,500. So I'm going to be getting about $42.54, and then we're going to have mortgage payment we're going to have to make. So after the mortgage, I'm going to be making about $3,566 per year, which is about $297 a month. So luckily this, these are all done calculations that it spits out for you. I contributed 12 grand, annual cash flow $35.66, so that's about a 29% return on my investment, which is the exact same as it should be, because everything over here is just half since I'm a 50-50 partner. So that wraps up this spreadsheet tutorial. As you can see, it's a pretty in-depth tutorial, or a pretty in-depth spreadsheet, I should say. You've got all your basic property information in section 1. Section 2 is going to analyze it as a rental. And then if you're flipping it, you could put in, what kind of value you're going to get, and it'll calculate down here in section 3. Hybrid is what it's called, meaning, it's adding in your rental plus your flip profits, and it's going to spit out a total ROI per year. And then if you're going in with a partner on a deal, you can punch in all the numbers over here in the far right column that you're responsible for, and it'll spit out your return. So if you guys don't have a 50-50 split, if you've got like a 30-70 split or 60-40, then obviously these numbers are going to be a lot different. So it'll be a good calculator to figure out what your share of everything would be and what your return would be. So thanks for watching this tutorial. If you found it helpful, give it a thumbs up. Be sure to subscribe to the channel and click the link in the description. I'll link to this spreadsheet so you can download it and then you can get started using it.